Question 1. Which of the following would generally be considered a non-allowable asset for purposes of Net Capital Rule 15C3-1? A. Customer receivables over 30 days old. B. Securities owned by the firm readily marketable. C. Fully collateralized bank loans. D. Exchange memberships owned by the firm. Answer: A. Customer receivables over 30 days old. Explanation: customer receivables that are over 30 days old are typically considered non-allowable assets under SEC Rule 15C3-1, meaning they must be deducted from a broker-dealer's net worth when calculating net capital. This deduction ensures that a firm's regulatory capital is composed of highly liquid and dependable assets, protecting customers and other creditors from potential losses. The rule aims to prevent firms from relying on assets that may be difficult or impossible to collect in a timely manner during a financial distress situation. Therefore, proper aging and classification of receivables are critical for accurate net capital computations. Question 2. Under SEC Rule 15C3-3, a broker-dealer must make a P&I, possession or control, determination for customer fully paid and excess margin securities no later than A. The end of the business day following receipt. B. The close of business on settlement date. C. The business day following the settlement date. D. The last business day of each month. Answer: C. The business day following the settlement date. Explanation: SEC Rule 15C3-3, known as the Customer Protection Rule, requires broker-dealers to make a P&I, possession or control, determination for customer fully paid and excess margin securities by the close of business on the business day following the settlement date. This rule is fundamental to ensuring the safeguarding of customer securities and preventing their misuse by the broker-dealer. The firm must promptly bring these securities into its physical possession or control within specified locations, such as a bank or clearing corporation, to protect customer assets from the firm's own financial difficulties. Adherence to this timeline is critical for compliance and customer protection. Question 3. A broker-dealer's minimum net capital requirement is determined by all of the following except the greater of its basic or alternative method calculation. B. The type of business activities conducted. C. Its aggregate indebtedness ratio. D. Its level of proprietary trading. Answer: C. Its aggregate indebtedness ratio. Explanation: while a broker-dealer's aggregate indebtedness ratio is a critical component of its net capital compliance, it does not determine the minimum net capital requirement itself. The minimum requirement is established based on the firm's business model, e.g., introducing, carrying, which dictates whether it uses the basic method or alternative method, and its related operational scale. The ratio, AI to net capital, indicates whether the firm is meeting its requirement, not what the requirement initially is. Proprietary trading levels can influence the amount of capital needed due to haircuts, but the base minimum is set by the firm's functional role. Question 4. Which focus report form would a non-carrying broker-dealer typically file? A. Form X-17A-5, Part 2. B. Form X-17A-5, Part IA. C. Schedule 1. D. Form X-17A-5, Part 3. Answer: B. Form X-17A-5, Part IA. Explanation: non-carrying broker-dealers, meaning those that do not hold customer funds or securities, typically file Form X-17A-5, Part IA of the focus report. Part IA is specifically designed for these types of firms to report their financial condition and operational results to regulators. In contrast, Part 2 is filed by carrying broker-dealers, who do hold customer funds and securities. The focus report is a crucial regulatory filing required by the SEC to monitor the financial health, capital adequacy, and operational compliance of all registered broker-dealers, ensuring market integrity and investor protection. Question 5. What is the primary purpose of the reserve formula under SEC Rule 15C3-3? A. To calculate the amount of capital required to support proprietary trading activities. B. To determine the amount of cash or qualified securities a broker-dealer must deposit into a special reserve bank account for the exclusive benefit of customers. C. To assess the haircut deductions for various securities held in inventory. D. To track the firm's aggregate indebtedness to ensure it does not exceed net capital. Answer B. To determine the amount of cash or qualified securities a broker-dealer must deposit into a special reserve bank account for the exclusive benefit of customers. Explanation. The primary purpose of the reserve formula under SEC Rule 15c3-3 is to determine the amount of cash or qualified securities a broker-dealer must deposit into a special reserve bank account for the exclusive benefit of customers. This calculation ensures that customer funds held by the firm are adequately segregated and protected from the firm's own liabilities. By requiring a reserve, the rule aims to safeguard customer assets and provide a cushion against potential firm insolvency, thereby enhancing investor confidence and market stability. Maintaining this reserve is a critical component of customer protection regulations. Question 6. Under FINRA Rule 4511, what is the minimum period for which broker-dealers must retain records of original entry? 3 years. B. 5 years. C. 6 years. D. Life of the firm. Answer C. 6 years. Explanation. FINRA Rule 4511, which incorporates the record-keeping requirements of SEC Rule 17a-4, mandates that broker-dealers retain records of original entry, such as blotters, for a minimum period of 6 years. These records are crucial for reconstructing transactions and providing an audit trail for regulatory oversight. The rule specifies that for the first 2 years, these records must be kept in an easily accessible location. Adhering to these record-keeping requirements is essential for firms to demonstrate compliance, facilitate regulatory examinations, and protect both the firm and its customers. Question 7. A broker-dealer operating under the alternative net capital method must maintain minimum net capital of at least $250,000. B. $500,000. C. $1 million. D. The greater of $250,000 or 2% of aggregate debit items. Answer D. The greater of $250,000 or 2% of aggregate debit items. Explanation. A broker-dealer operating under the alternative net capital method, typically used by firms that carry customer accounts, must maintain minimum net capital of at least the greater of $250,000 or 2% of aggregate debit items arising from customer accounts. This method offers an alternative to the basic method, which focuses on an aggregate indebtedness ratio. The alternative method is generally favored by larger, more complex firms, as it can sometimes result in a lower required capital amount, provided the firm can effectively manage its customer debits. Ensuring compliance with this calculation is vital for a firm's regulatory standing and financial stability. Question 8. Which of the following is not typically a component of a broker-dealer's general ledger for regulatory reporting purposes? Assets and liabilities. B. Income and expenses. C. Capital accounts. D. Customer suitability profiles. Answer D. Customer suitability profiles. Explanation. Customer suitability profiles are not typically a direct component of a broker-dealer's general ledger, which is used for financial accounting and regulatory reporting of assets, liabilities, income, expenses, and capital accounts. While suitability profiles are critical regulatory records, they are maintained separately to document the appropriateness of recommendations made to clients, rather than being part of the firm's financial statements. The general ledger focuses on the firm's financial transactions and position, providing the foundation for reports like the Focus Report. Maintaining distinct records ensures clarity in both financial reporting and compliance with suitability rules. Question 9. When computing net capital, a broker-dealer must apply a haircut to its proprietary positions. What is the standard haircut for common stocks that are readily marketable? 15%. B. 20%. C. 30%. D. 50%. Answer A. 15%. Explanation. For purposes of computing net capital, a broker-dealer must apply a standard haircut of 15% to its proprietary positions in common stocks that are readily marketable. A haircut is a percentage deduction from the market value of a security, designed to account for potential market risk and price fluctuations. This conservative valuation ensures that the firm has sufficient capital even if the value of its proprietary holdings declines. Proper application of these haircuts is essential for accurate net capital calculations and for meeting regulatory capital requirements, ultimately protecting investors and the financial system. Question 10. According to SEC Rule 17a-11, a broker-dealer must provide immediate notice to the SEC and FINRA if its net capital falls below its minimum requirement. B. 150% of its minimum requirement. C. 120% of its minimum requirement. D. 200% of its minimum requirement. Answer: C. 120% of its minimum requirement. Explanation: under SEC Rule 17a-11, a broker-dealer is required to provide immediate telegraphic or electronic notice to the SEC and FINRA if its net capital falls below 120% of its minimum net capital requirement. This early warning notification is designed to alert regulators to potential financial difficulties before a firm is in a critical non-compliance state. Prompt notification allows regulators to take timely action, such as increased monitoring or intervention, to prevent further deterioration and protect customers. Firms must rigorously monitor their net capital levels to ensure they remain above this critical threshold. Question 11. The FINOP, Financial and Operations Principle, is primarily responsible for A. Supervising sales practices of registered representatives. B. Ensuring compliance with anti-money laundering regulations only. C. The overall financial and operational management of a broker-dealer, including record-keeping and net capital compliance. D. Developing new business strategies and marketing plans. Answer: C. The overall financial and operational management of a broker-dealer, including record-keeping and net capital compliance. Explanation: the FINOP, Financial and Operations Principle, holds a critical role, primarily responsible for the overall financial and operational management of a broker-dealer, including strict adherence to record-keeping requirements, net capital rules and customer protection regulations. While AML compliance is a part of their duties, their responsibility extends far beyond that to encompass the entire financial integrity of the firm. The FINOP ensures that the firm maintains sufficient capital, accurate financial records, and robust operational controls, which are fundamental to meeting regulatory obligations and safeguarding customer assets. This comprehensive oversight is essential for the firm's stability and compliance. Question 12. Which of the following describes the aggregate indebtedness (AI) method for calculating net capital? A. Net capital must be at least 2% of aggregate debit items. B. Net capital must be at least 8% of aggregate indebtedness for the first year, then 15%. C. Net capital must be at least $250,000 regardless of AI. D. Net capital must be at least 6.67% of aggregate indebtedness for the first year, then 15%. Answer: D. Net capital must be at least 6.67% of aggregate indebtedness for the first year, then 15%. Explanation: the aggregate indebtedness (AI) method for calculating net capital, also known as the basic method, requires that a broker-dealer's net capital be at least 6.67% of its aggregate indebtedness during its first year of operation, and thereafter at least 15% of aggregate indebtedness. This method links the required capital directly to the firm's outstanding liabilities. Firms must also meet a minimum dollar amount, which varies depending on their business model. The purpose of this ratio is to ensure that the firm maintains a healthy capital buffer in relation to its short-term liabilities, providing a measure of solvency and protecting creditors. Question 13. Which SEC rule governs the general record-keeping requirements for broker-dealers? AC Rule 15C3-1. B. AC Rule 15C3-3. C. SEC Rule 17A3 and 17A4. D. AC Rule 17F2. Answer: C. AC Rule 17A3 and 17A4. Explanation: SEC Rules 17A3 and 17A4 govern the general record-keeping requirements for broker-dealers. Rule 17A3 specifies the types of books and records that must be maintained, such as blotters, ledgers, and customer account records. Rule 17A4 dictates the retention periods for these records and how they must be stored, emphasizing accessibility and integrity. These rules are foundational for regulatory oversight, allowing authorities to reconstruct transactions, examine a firm's financial health, and ensure compliance with all applicable securities laws. Proper record keeping is essential for firm operations, compliance, and investor protection. Question 14. Under SEC Rule 15C3-3, a broker-dealer's special reserve bank account for the exclusive benefit of customers must be maintained at a foreign bank. B. Any commercial bank that is a member of the Federal Reserve System. C. A FINRA-approved clearing corporation. D. An investment bank. Answer: B. Any commercial bank that is a member of the Federal Reserve System. Explanation: under SEC Rule 15C3-3, the special reserve bank account for the exclusive benefit of customers must be maintained at a commercial bank that is a member of the Federal Reserve System. This requirement ensures that the funds are held in a secure, regulated institution, separate from the broker-dealer's operational accounts. The segregation of customer funds in such an account is a critical component of the Customer Protection Rule, designed to shield customer assets from the firm's general creditors in the event of insolvency. This measure enhances customer confidence and market stability by safeguarding their cash and securities. Question 15. A broker-dealer must file its focus report on Form X-17A-5. Annually only. B. Quarterly only. C. Monthly or quarterly depending on the firm's size and clearing status. D. Only when specifically requested by the SEC or FINRA. Answer: C. Monthly or quarterly depending on the firm's size and clearing status. Explanation: a broker-dealer must file its focus report on Form X-17A-5 either monthly or quarterly, depending on the firm's size, clearing status, and other regulatory criteria. Carrying broker-dealers typically file monthly, while non-carrying or smaller firms might file quarterly. Regardless of the frequency, an annual audited financial statement is always required. The focus report is a crucial regulatory filing used by the SEC and FINRA to monitor the financial health, capital adequacy, and operational compliance of registered broker-dealers, ensuring market integrity and investor protection. Question 16. Which of the following is considered an allowable asset for net capital purposes, subject to certain conditions? A. Fixed assets, e.g. office furniture. B. Prepaid expenses. C. Certain unsecured receivables from customers and margin accounts. D. Good faith deposits from customers. Answer: D. Good faith deposits from customers. Explanation: good faith deposits from customers, often associated with syndicate participations or new issues, can be considered allowable assets for net capital purposes, provided they meet specific conditions, such as being segregated and promptly applied. In contrast, fixed assets and prepaid expenses are generally non-allowable, as they are not easily convertible to cash. Unsecured receivables from customers are typically non-allowable if over 30 days old. The classification of assets for net capital is crucial, as it determines a firm's regulatory capital and its ability to meet its financial obligations, thereby protecting investors. Question 17. What is the primary function of a subordinated loan agreement in the context of a broker-dealer's capital structure? To provide unsecured financing for daily operations. B. To increase the firm's regulatory net capital by adding eligible liabilities. C. To reduce the firm's aggregate indebtedness. D. To allow the firm to lend money to its customers. Answer: B. To increase the firm's regulatory net capital by adding eligible liabilities. Explanation: a subordinated loan agreement is a critical tool for broker-dealers, primarily functioning to increase the firm's regulatory net capital by allowing eligible liabilities to be treated as capital. These loans are subordinated, meaning that in the event of liquidation, they are paid only after all other general creditors, including customers, have been satisfied. This characteristic makes them a stable source of capital from a regulatory perspective. While they provide financing, their specific regulatory benefit is enhancing net capital, thereby helping the firm meet its Rule 15C3-1 requirements and providing a greater cushion for customer protection. Question 18. The purpose of a business continuity plan (BCP) for a broker-dealer, according to FINRA Rule 4370, is to a. Detail the firm's marketing and sales strategies. b. Ensure that the firm can quickly recover from significant business disruptions and continue operations. c. Outline the firm's internal audit procedures. D. Describe the firm's annual budget and financial projections. Answer B. Ensure that the firm can quickly recover from significant business disruptions and continue operations. Explanation. The primary purpose of a business continuity plan (BCP) for a broker-dealer as mandated by FINRA Rule 4370 is to ensure that the firm can quickly recover from significant business disruptions and continue its operations. This includes maintaining critical systems, ensuring access to customer funds and securities, and communicating with customers and regulators. A robust BCP is essential for protecting investors, maintaining market integrity, and mitigating risks associated with unforeseen events such as natural disasters, technological failures, or other emergencies. Regularly testing and updating the BCP is crucial for its effectiveness. Question 19. An introducing broker-dealer that does not carry customer accounts or hold customer funds or securities and clears its transactions on a fully disclosed basis would most likely have a minimum net capital requirement of $5,000. B. $50,000. C. $100,000. D. $250,000. Answer A. $5,000. Explanation. An introducing broker-dealer that does not carry customer accounts, hold customer funds or securities, and clears its transactions on a fully disclosed basis typically falls into the lowest minimum net capital requirement category, which is $5,000. These firms have very limited exposure to customer assets and operational risk, as their clearing firm handles the custody and settlement functions. The different minimum net capital requirements are designed to align with the varying levels of risk associated with different business models, ensuring adequate capital buffers are in place to protect investors. It is crucial for a firm to correctly identify its business model to determine its applicable minimum capital. Question 20. Haircuts for proprietary positions in options contracts are calculated based on A. The underlying securities haircut percentage. B. The aggregate market value of the options positions. C. A percentage of the options premium, adjusted for volatility. D. A complex formula involving the options delta, gamma, and underlying security price. Answer D. A complex formula involving the options delta, gamma, and underlying security price. Explanation. Haircuts for proprietary positions in options contracts are calculated using a complex formula that involves factors such as the options delta, gamma, and the underlying security price, rather than a simple percentage of the premium or underlying security haircut. This is due to the nonlinear nature of options and their sensitivity to changes in the underlying asset's price, volatility, and time decay. The FINOP must apply specific regulatory methodologies, e.g., CBOE haircut method or specific SEC-approved models, to accurately assess the risk and determine the appropriate capital charge for these positions. This detailed approach ensures that the firm maintains adequate capital to cover potential losses from its options trading activities. Question 21. Which of the following statements is true regarding the treatment of readily marketable municipal securities for net capital purposes? A. They are exempt from haircuts. B. They are subject to a uniform 15% haircut. C. Their haircut is based on their maturity. D. Their haircut is based on their credit rating only. Answer C. Their haircut is based on their maturity. Explanation. For readily marketable municipal securities, the haircut applied for net capital purposes is based on their maturity, not a uniform percentage. Securities with shorter maturities generally have lower haircuts, reflecting their reduced interest rate risk, while longer maturities incur higher haircuts. This graduated approach acknowledges that the price volatility of fixed income securities is directly related to their time until maturity. Properly applying these maturity-based haircuts is essential for accurate net capital calculations and for reflecting the true market risk of a firm's bond portfolio. Question 22. A broker-dealer's balance sheet for regulatory purposes must disclose its financial condition as of A. The beginning of its fiscal year. B. The end of its fiscal year only. C. The date of the report, presenting a snapshot of its financial position. D. The average over the reporting period. Answer C. The date of the report, presenting a snapshot of its financial position. Explanation. A broker-dealer's balance sheet for regulatory purposes, such as that included in the focus report, must disclose its financial condition as of the date of the report, presenting a snapshot of its financial position at a specific point in time. Unlike an income statement which covers a period, a balance sheet shows assets, liabilities, and equity on a particular day. This snapshot approach is crucial for regulators to assess the firm's capital adequacy and overall financial health at discrete intervals. Accurate and timely reporting of this snapshot is fundamental to regulatory compliance and market oversight. Question 23. The early warning notification requirement under SEC Rule 17a-11 applies if a firm's aggregate indebtedness exceeds a 100% of its net capital, b. 1,200% of its net capital, c. 1,500% of its net capital, d. 1,000% of its net capital for 2 consecutive months. Answer: C. 1,500% of its net capital. Explanation: the early warning notification requirement under SEC Rule 17a-11 is triggered if a firm's aggregate indebtedness exceeds 1,500% 15-to-1 ratio of its net capital. This threshold is specifically for firms operating under the basic method. Reaching this level indicates a potentially deteriorating financial condition where the firm's liabilities are significantly outpacing its available capital. Prompt notification to regulators is critical, allowing them to intervene early and monitor the firm's financial situation closely, thereby protecting customer assets and market integrity. This rule is a cornerstone of regulatory oversight for broker-dealers. Question 24. A broker-dealer must calculate its formula for determination of reserve requirements for brokers and dealers, reserve formula, at least daily, b. weekly, monthly, d. quarterly. Answer: B. weekly. Explanation: a broker-dealer must calculate its formula for determination of reserve requirements for brokers and dealers, reserve formula, at least weekly. This calculation is a critical component of SEC Rule 15c3-3, the Customer Protection Rule. It determines the amount of cash or qualified securities that the firm must deposit into a special reserve bank account for the exclusive benefit of customers. The weekly frequency ensures that customer funds are adequately protected against the firm's liabilities by reflecting current debits and credits, safeguarding customer assets, and maintaining investor confidence. Question 25. Which of the following is typically a non-allowable asset for net capital computation without exception? Securities owned by the firm subject to haircut. B. Fixed assets such as office equipment and leasehold improvements. C. Accrued interest on government securities. D. Exchange memberships held by the firm. Answer: B. Fixed assets such as office equipment and leasehold improvements. Explanation: fixed assets such as office equipment, furniture, and leasehold improvements are typically considered non-allowable assets for net capital computation without exception. These assets are not readily convertible into cash and therefore cannot be relied upon to meet immediate financial obligations to customers or creditors in a liquidation scenario. Net capital rules prioritize liquid assets that can quickly be used to cover liabilities, while other assets like securities are allowable after haircuts, or exchange memberships might be allowable under specific conditions. Fixed assets are consistently excluded to ensure capital adequacy reflects true financial liquidity. Question 26. What is the key difference between a broker-dealer's net capital and its net worth? A. Net capital is always higher than net worth. B. Net capital is a regulatory measure based on adjusted net worth, while net worth is a GAAP accounting measure. C. Net worth includes only tangible assets, while net capital includes all assets. D. Net capital is calculated monthly, while net worth is calculated annually. Answer: B. Net capital is a regulatory measure based on adjusted net worth, while net worth is a GAAP accounting measure. Explanation: the key difference is that net worth is a generally accepted accounting principles, GAAP, measure representing assets minus liabilities, while net capital is a regulatory measure derived from net worth but subject to specific adjustments and deductions, haircuts for market risk, non-allowable assets. Net capital aims to present a conservative estimate of a firm's liquid assets available to cover liabilities, especially to customers in a liquidation scenario. This distinction is crucial for regulatory compliance, as firms must always satisfy their net capital requirement, which is far more stringent than a simple accounting net worth. Question 27. Under what circumstance must a broker-dealer provide notification to FINRA regarding a change in its independent public accountant? A. Only if the change is due to the accountant's retirement. B. Within 30 days of the change, along with the reasons for the change. C. Only if the new accountant is not SEC registered. D. No notification is required unless the change impacts net capital calculations. Answer: B. Within 30 days of the change, along with the reasons for the change. Explanation: a broker-dealer must provide notification to FINRA and the SEC regarding a change in its independent public accountant within 30 days of the change, along with a detailed explanation of the reasons for the change. This requirement is critical for regulatory oversight, as the independent public accountant performs the annual audit of the firm's financial statements, which is a cornerstone of regulatory compliance. Regulators need to be aware of any issues or disagreements that may have led to the change, as these could signal underlying financial or operational problems within the firm. Timely reporting ensures transparency and continuous oversight of the firm's financial reporting integrity. Question 28. Under SEC Rule 15c3-3, if a broker-dealer finds a deficiency in its reserve formula computation, by when must the required deposit be made into the special reserve bank account? A. Within 24 hours of the computation. B. By the close of business on the business day following the computation. C. By the second business day following the computation. D. Within 5 business days of the computation. Answer: C. By the second business day following the computation. Explanation: SEC Rule 15c3-3 requires that if a deficiency is found in the reserve formula computation, the broker-dealer must deposit the required amount of cash or qualified securities into the special reserve bank account for the exclusive benefit of customers no later than the second business day following the date of the computation. This prompt action ensures that customer funds are always adequately protected and segregated, demonstrating immediate compliance with the customer protection rule and preventing potential misuse of customer assets. Question 29. A broker-dealer has a contingent liability from a pending lawsuit. For net capital purposes, how is this typically treated? A. It is always deducted from net capital as a definite liability. B. It is ignored until the lawsuit is resolved. C. It may require a capital charge if the liability is probable and reasonably estimable. D. It is considered an allowable asset until proven otherwise. Answer: C. It may require a capital charge if the liability is probable and reasonably estimable. Explanation: for net capital purposes, a contingent liability from a pending lawsuit may require a capital charge if the liability is deemed probable and reasonably estimable. While it's not always an immediate dollar-for-dollar deduction, FINRA guidance and accounting principles require firms to assess the likelihood and potential impact of such liabilities. If a loss is both probable and estimable, an appropriate deduction or reserve should be made to reflect the potential financial impact on the firm's capital. This conservative approach ensures that a firm's reported net capital adequately accounts for known and foreseeable risks, protecting customers and maintaining financial stability. Question 30. What is the primary objective of the annual audit requirement for broker-dealers under SEC Rule 17a-5? A. To assess the firm's marketing effectiveness. B. To verify the accuracy of the firm's financial statements and compliance with regulatory capital rules. C. To train new employees on financial reporting procedures. D. To identify opportunities for cost reduction within the firm's operations. Answer: B. To verify the accuracy of the firm's financial statements and compliance with regulatory capital rules. Explanation: the primary objective of the annual audit requirement for broker-dealers, mandated by SEC Rule 17a-5, is to verify the accuracy of the firm's financial statements and its compliance with regulatory capital rules, including the Net Capital Rule 15c3-1 and the Customer Protection Rule 15c3-3. An independent public accountant performs this audit to provide an unbiased assessment of the firm's financial health and operational controls. This annual examination is critical for ensuring transparency, protecting investors, and maintaining the integrity of the securities markets by holding firms accountable for their financial reporting and regulatory adherence. Question 31. Which FINRA rule outlines the requirements for a broker-dealer's anti-money laundering (AML) compliance program? FINRA Rule 2090. B. FINRA Rule 3110. C. FINRA Rule 3310. D. FINRA Rule 4511. Answer: C. FINRA Rule 3310. Explanation: FINRA Rule 3310 outlines the requirements for a broker-dealer's anti-money laundering (AML) compliance program. This rule mandates that firms develop and implement written AML programs reasonably designed to achieve compliance with the Bank Secrecy Act and its implementing regulations. Key components include designating an AML compliance officer, conducting ongoing training, performing independent testing, and filing suspicious activity reports (SARs). The rigorous enforcement of AML regulations is crucial for preventing illicit financial activities and protecting the integrity of the financial system, making it a critical area of responsibility for the FINOP and senior management. Question 32. What is the impact of a secured demand note on a broker-dealer's net capital? A. It is treated as a non-allowable asset. B. It increases aggregate indebtedness. C. It is included as regulatory capital, subject to specific conditions. D. It is subject to a 100% haircut. Answer: C. It is included as regulatory capital, subject to specific conditions. Explanation: A secured demand note, SDN, is a unique financing instrument that, under specific conditions outlined in SEC Rule 15c3-1, can be included as regulatory capital for a broker-dealer. The SDN is a promissory note collateralized by securities or other acceptable assets, which is then subordinated to the claims of general creditors and customers. This means the collateral cannot be accessed until all other liabilities are satisfied. By adding to a firm's capital base without increasing aggregate indebtedness, SDNs provide a flexible way for firms to meet their net capital requirements, demonstrating financial stability and increasing protection for customers. Question 33. When calculating the reserve formula under SEC Rule 15c3-3, what is the treatment of fails to receive related to customer accounts? Included as a debit item. B. Included as a credit item. C. Excluded from the calculation. D. Included only if over 30 days old. Answer: A. Included as a debit item. Explanation: when calculating the reserve formula under SEC Rule 15c3-3, fails to receive related to customer accounts are included as a debit item. A fail to receive occurs when a broker-dealer has not yet received securities from a counterparty by the settlement date for a transaction where the customer has already been debited or paid. This represents an amount owed to the firm, and as such, it increases the total debit balance in the reserve formula. This inclusion is crucial for accurately determining the required deposit into the special reserve bank account, ensuring customer protection by reflecting the firm's current obligations and entitlements. Question 34. The required minimum net capital for an introducing broker-dealer that receives customer funds and/or securities but clears through another broker-dealer on a fully disclosed basis is typically $5,000. B. $50,000. C. $100,000. D. $250,000. Answer: B. $50,000. Explanation: the required minimum net capital for an introducing broker-dealer that receives customer funds and/or securities but clears through another broker-dealer on a fully disclosed basis is typically $50,000. This category of firm takes on slightly more responsibility and risk than a firm that does not handle customer funds or securities at all, hence the higher capital requirement than the $5,000 minimum. The capital is required to cover potential liabilities associated with the temporary handling of customer assets before they are forwarded to the clearing firm. Adherence to this specific minimum is vital for regulatory compliance and safeguarding investor interests. Question 35. Which of the following is not a primary purpose of FINRA's Financial and Operational Combined Uniform Single Focus Report? A. To monitor a broker-dealer's net capital compliance. B. To provide data for economic research and market analysis. C. To assess the firm's compliance with customer protection rules. D. To evaluate the firm's profitability and revenue growth over time. Answer D. To evaluate the firm's profitability and revenue growth over time. Explanation. While the focus report does contain financial information from which profitability can be inferred, its primary purposes are regulatory: to monitor a broker-dealer's net capital compliance, assess adherence to customer protection rules, and generally oversee the firm's financial health. The report is not primarily designed to evaluate a firm's profitability and revenue growth as a business metric for investors, but rather its solvency and operational integrity from a regulatory perspective. Regulators use the focus report as a crucial tool for surveillance and ensuring market stability, not for assessing investment potential.